Welcome to Iron Financial, the place you come to forge a stronger portfolio and cut right through the weakness in the market. Today, Charles Schwab is in the hot seat. They just dropped their Q1 2026 earnings, and if you just read the headlines, you'd think it was a massive victory parade. But we don't trade headlines here, we analyze the blueprints. I'm your lead analyst, and we are about to conduct a full structural analysis to see what this financial giant is really made of. And, as always, here to keep me honest, our market skeptic.
Glad to be here, because blockbuster quarter sounds great, but is the foundation solid rock, or is this whole thing just built on sand? The market seems to love the numbers, sure, but I'm here to ask if a shiny new coat of paint is just hiding some serious structural problems underneath. Look, headlines are easy. What we're going to do is check the foundation. We're going to stress test the support beams, and we're going to find out if this thing is actually built to last. We need to know, is this a genuine opportunity, or is it just a very well-disguised trap?
All right, here's our blueprint for today's deep dive. First, we're going to set the stage and look at what Wall Street was demanding. Then, we'll see how Schwab actually performed against those incredibly high expectations. After that, we are tearing open the growth engine, really getting into the guts to see what's driving this machine. Then, it's your turn to apply some pressure, and we'll stress test the whole structure for flaws. Finally, we assemble the final blueprint and deliver our verdict. Let's get to work.
To really understand the scale of a win, you first have to understand just how tough the fight was expected to be. And in this case, the market wasn't just hoping for a good quarter. Wall Street was demanding a show of absolute force. So before we can even begin to judge the results, we have to establish just how incredibly high that bar was set.
Now just look at these numbers. This is what Wall Street was expecting. No, demanding. They wanted adjusted earnings per share to come in as high as $1.39. But look at that column on the right. That implies year-over-year growth of around 30%. That is a massive expectation. They wanted net revenue up around 14%, and a core engine's net interest revenue and trading revenue both were expected to jump by about 18%. This bar wasn't just high, it was in the stratosphere. Wall Street was pricing in a quarter of spectacular growth.
Right, and the market called this cautiously optimistic. You know what that really means? That's Wall Street speak for you better deliver or else. That plus or minus 4% potential move the options market was pricing in, that tells you everything. That's the coiled spring. Traders were betting on a huge move one way or the other. They were expecting fireworks. This wasn't just another earnings report, it was a high-pressure test. The pressure was on Schwab to prove they could clear that incredibly high bar.
Okay, so the market was holding its breath. The expectations were sky high, and now the results are in. It's time to measure Schwab's performance against that incredibly demanding bar that Wall Street set. Let's see if the structure held up under that kind of pressure or if it buckled. And here we go, the bottom line. The absolute highest end of Wall Street's expectation was $1.39. Schwab delivered $1.43. Now that is not a little beat, that's not a rounding error. That is a clear, decisive statement of strength and execution. In a quarter where everyone was demanding near perfection, they delivered more. This is the very first sign of some real structural integrity here.
And this wasn't just some clever accounting on the bottom line. The top-line revenue, it tells the exact same story. The street was hoping for about $6.47 billion. Schwab came in and posted $6.48 billion. You know what's more important? This was a new company record. They didn't just meet the high expectations, they went out and set a new high watermark for the entire company. It just shows you the sheer momentum behind this financial machine.
And there it is, the victory lap from management. Of course, the CFO, Mike Fredeschi, is going to say, Schwab's diversified model delivered record results. That's exactly what he's paid to say, right? We're amazing. Our strategy works perfectly. Nothing to see here. But is that really the whole picture? Come on. We need to dig a lot deeper than some canned quote in a press release to understand how they actually pulled this off.
He's absolutely right. They smashed the headline numbers. That part is settled. But the headline is just the facade of the building. To understand if it's got real strength, we have to go inside. We're going down into the engine room. We're going to inspect every single component, every gear, every piston, to see how they did the heavy lifting required to post these kinds of numbers. This is where we separate the C-suite talk from the hard market reality.
Let's start with the foundation, the raw scale of this operation. You can't build a fortress without a mountain of raw material, while Schwab's mountain is almost $12 trillion in total client assets. 11.77 trillion to be precise. And this mountain, it's not static. It grew by a massive 19% from this time last year. This is the bedrock. This is the foundation of their entire business. This kind of scale gives them unbelievable financial power and a competitive moat that is just vast.
Okay, hang on a second. So they reported $140 billion in what they're calling core net new assets. But this chart shows that they also had this planned outflow of $17.5 billion that they're choosing to ignore in the bigger number. Why? Why separate it out like that? It feels a little like they're trying to have their cake and eat it too. They're reporting the official, lower number for the record, but they're winking at us with a higher, informal number. It's a bit of financial gymnastics that makes me wonder what else is being massaged.
All right, let's set aside the asset reporting games for a moment and look at something that's concrete, something that directly fueled that revenue beat. Look at this chart. Daily average trades, a record 9.9 million. Now compare the bar for Q1 2025 to Q1 2026. That is an explosive 34% increase. This tells you their client base isn't just sitting on their hands. These are active, engaged clients generating record trading revenues. It tells you the engine is running hot, maybe even redlining, and that activity is directly powering these record results.
And this engine isn't just a one-trick pony. Look here at their bank loan growth, up 29% year over year, hitting almost $61 billion. This shows they are successfully getting deeper into their clients' wallets, cross-selling banking products to their brokerage customers. But, and this is a big but, while that's fantastic for revenue, what about the risk? Is this quality lending, or are they just chasing growth by taking on riskier loans to hit that number? Because rapid loan growth looks great right up until the moment it doesn't.
So when all your engines are firing on all cylinders, what does a confident management team do? They return capital to the owners. They bought back $2.4 billion of their own stock and hiked the dividend by a massive 19%. Now, on one hand, that's a huge vote of confidence. On the other hand, you could see it as a way to keep investors happy and distract them from some of the questions we're raising. I want to know if this is truly a sign of sustainable strength, or if it's just a short-term sugar high for the stock price. Whoa, hold on. You're painting a beautiful picture here. A gleaming skyscraper with powerful engines in the basement. It's impressive, but I've seen a lot of beautiful buildings that couldn't handle a real storm. Every single fortress has a weak point. Every engine can overheat and blow a gasket. So enough with the victory lap. It's time to get out the analytical sledgehammers. It is time to apply some real pressure and see if we can find the cracks in this supposedly perfect structure.
Exactly. You love to talk about power and growth and record numbers. I want to talk about efficiency. I want to talk about the cost. An engine that is redlining like that is burning through a tremendous amount of fuel. So my question is simple. What did it cost them to generate that record-breaking revenue? Are they maintaining their discipline, or are they just throwing money into the furnace to keep the machine running at a pace that might be completely unsustainable? Because power is absolutely useless if it's not efficient.
And this data table starts to tell that story. First, just look at that expense line. Expenses, not counting interest, climbed to almost $3.3 billion. That's up from about $3.15 billion just last quarter. So costs are climbing, and they're climbing fast. Now look down at the pre-tax profit margin. Okay, 49.2% is an incredible margin. Nobody's denying that. But look at the quarter right before it, Q4 of 2025. They were at 50.2%. It's a dip. It might be a small one, but it shows that the rising cost of all this growth is starting to chip away at their peak profitability. This is the first potential hairline crack in the foundation.
And here is another potential stress point. And it's a big one. It's called net interest margin, or NIM. Basically, it's the spread between what they earn on their loans and what they have to pay out on their deposits. Their current NIM is 2.88%. The big risk here is something called deposit shifts. And what that means is that clients are getting smarter. They're not just going to leave their cash sitting in a Schwab checking account, earning basically nothing anymore. They're moving it into higher yield money market funds, which forces Schwab to pay them more. Every dollar that shifts directly squeezes that 2.88% spread. How big of a vulnerability is this really?
The risk is very, very real. So let's put it all together. Let's lay out all the potential weak spots on the blueprint. First, operating expenses are running hot, with compensation and benefits up a full 8% year over year. That's a red flag for cost control. Second, can they really keep up this record-shattering trading activity, or was this just a one-time surge driven by market insanity that's going to fade? Third, that net interest margin compression we just talked about, that's a major headwind that is not going away. And finally, that huge $12 trillion mountain of assets, its value is chained directly to the health of the stock market. A serious market downturn is a direct body blow to their fee revenue. Don't let the shiny headline numbers blind you to these very real stress points.
Those are all fair points. A structure is only as strong as its weakest link, and you've definitely put your finger on the potential fault lines. So now, it is time to put it all together. We are going to assemble the final blueprint. weighing the immense, undeniable strength of this company against those potential cracks you've identified. It is time to deliver the final verdict. Is Charles Schwab a powerful opportunity for your portfolio, or is it a gilded trap?
Okay, let's be absolutely clear. The bull case here is overwhelming. This company is a financial fortress. It is an asset-gathering machine that is simply without peer, pulling in a net $140 billion in a single quarter. Its revenue engines are beautifully diversified. You have wealth management, you have banking, you have trading, and all of them are firing at full power. Client engagement is at an all-time high, which is a sign of a very healthy, very sticky customer base. And on top of it all, its capital position is rock solid, strong enough to aggressively reward its shareholders. This is a company operating from a position of immense, undeniable structural strength.
But this is critical. We cannot ignore the cracks. That expense growth is a very real concern, and it has to be watched like a hawk going forward. That slight margin contraction, while it's small today, it proves they are not invincible. They are feeling the pressure from a rising rate environment. Their record trading performance is directly tied to high market volatility, which we all know cannot last forever. A quieter market could cool that revenue engine off in a hurry. And most importantly, their core banking profitability is fundamentally vulnerable to those deposit shifts and the broader direction of interest rates. These are not minor issues. They are structural vulnerabilities that have to be respected.
So, what is the final blueprint? Here it is. The foundation is solid rock. The structure is reinforced with concrete and steel. Yes, there are some hairline cracks that we've identified, the expense pressures, the margin sensitivity, and those absolutely need to be monitored quarter after quarter. But make no mistake, this is a financial fortress that appears to be built to withstand almost any imaginable economic storm. The heavy lifting they have done has clearly paid off. So the real question isn't about their internal weakness anymore. The question we want to leave you with is this. With a structure this dominant, a balance sheet this fortified, and a growth engine this powerful, what possible external force, what unforeseen black swan event could be big enough to truly challenge this behemoth's dominance in the year ahead?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.